and discuss what the outlook is when it comes to the QSR space. Get an appetite check, if you will, what the outlook is when it comes to demand, where there is value, consumer spending habits, and the kind of trends that we're seeing. A lot of players as well entering the space. And we've got Kunal Vora, who's head of equity research at BNP Paribas, now joining in to discuss that and lots more. Thanks so much for taking time out. And, I just want to discuss an overall view on the QSR space. Now, if we're looking at the sector of late, it has been in a bit of a slump, if you will. For example, Q1 was a bit subdued. There was a bit of an outlook from some positive companies, a positive outlook at that. What is the expectation when it comes to Q2, and how are you looking at the sector?
Yeah, thanks for having me. So if I look at what's been happening in the last few quarters is you've seen a slowdown in this industry. If I look at 4 or 5 quarters back, after the pandemic, the industry was growing at a fairly strong pace. It used to be mid-teens growth. In the last 4 quarters, we've seen the growth moderate to anywhere between 7 to 9%, which is well below what the market expectations have been. Market expectation even now is that these companies will grow at anywhere between 14 to 20% over the next couple of years. And the current trend is below what the market is expecting going forward, as well as what we've seen in the past. If I look at FY19 to FY24, the industry reported about 14% growth. Right now, we are at 8-9%. That's because of the decline in average revenue per store or same-store sales growth. And entire growth, which we've seen in the recent quarters, it's being driven by the store additions. Store additions have been fairly strong even now. They are moderating, but still strong at about 15% this quarter, year on year. But the revenue growth was only 8%, which means that average revenue per store has been fairly muted.
Right. The other thing I also wanted to talk about, if you take a look at the same-store sales growth, that has seen a decline for all players except perhaps a Jubilant and a Burger King. What do you think is working out for these companies among the QSR space? And how is it that they are managing to lead the rest of the sector?
So if you look at the trend in the last 4 or 5 quarters for Jubi, they were the laggards 4 quarters back. The revenue growth for some of the other peers was close to 20%, while Jubi's growth was only 6%. From that low base, they have managed to recover and they've caught up with peers. It's not that the growth is exceptional, while same-store sales growth looks good. It's not that the growth has been exceptional. It's more about a catch-up which they've seen. That's been led by some of the initiatives which the company has taken, which includes free delivery at a fairly small ticket size. Now, that does come at the cost of gross margins, while other peers have seen an expansion in gross margins. In case of Jubi, the gross margin has been flattish. On the EBITDA margin front, because entire growth which this industry is seeing right now is coming purely from store additions. On EBITDA margins, you are seeing declines happening. On a year-on-year basis, the listed players put together had flattish EBITDA against 8% increase in revenue. If I look at last 2 years, EBITDA margins, which used to be about 17-18%, they've come down to 12%. So, revenue growth has been sluggish, and that's also putting pressure on margins.
Okay. So, just to stretch that point further, has the worst when it comes to same-store sales growth bottomed out? Is that over for the space? And what's the expectation now when it goes into the coming quarters for same-store sales?
So from where we are right now, there should be some recovery. I don't think the current 7 to 9% revenue growth is going to continue. Having said that, compared to what the market expectations are, I believe that disappointments are likely to continue. What the market is currently expecting is the growth to recover to about 15%. Now, if I look at the store growth, store additions are slowing down. They used to be about 25% year on year. 4 quarters back, now 15% year on year. So store growth is slowing down. That's one of the levers for growth. Other one is pricing. And because of intense competition right now, no player is looking to take pricing. So volume will be the key driver. And between dine-in and delivery, dine-in is struggling right now. Consumers seem to have adopted delivery and are much more comfortable with that, because of which we are seeing across the board pressure on dine-in. In case of delivery, the main issue is fragmentation of the market. Aggregators have become very large. If I look at the top aggregators, they used to service from about 60,000 restaurants 5 years back. Today, that number is almost 2.76 lakh. So there is a lot more competition. The customer has more options, but that also means that for the QSR space, there is a lot more competition to deal with.
Let's look at Jubilant Foodworks. It's a blend of QSR and in dining. How would you view a business like Jubilant, which essentially has their own delivery, own sitting experience, and it's a business which is now competing with the Swiggy and the Zomatos of the world?
So the way I see it is in last 4-5 years, the big advantage which they had, which is delivery strength, has got diluted slightly. I mean, earlier 5 years back, you would have thought that by default, when you think about delivery, it will be Domino's. Today, there are many more which are able to deliver at a quick pace, efficiently. So there is a fragmentation in the market. Even the peers have expanded rapidly, and even they are able to now deliver riding on the aggregators. So delivery strength, if I look at last 5 years, their growth has been about 9%, while many peers have grown well ahead of that. On the dine-in front, the investments have been little lower compared to what the peers have made. It's not really the best when it comes to dine-in experience. So on both fronts, there has been some struggle for them, and which is reflecting in the weaker growth. And they have invested in new franchise. They are growing Popeyes. They have tried Hongs, Ekdum, etc. But all put together, growth rate has still been lower compared to what the peer group has been.
Pizzas are selling and burgers are not selling. West Side same store sales are down, and if I look at Jubilant same store sales, or for that matter Devyani same store sales, it appears that pizzas are selling in India and burgers are not selling. Am I right?
Oh, not really. Actually, what's happening is pizza has been a significant drag. What's done much better is KFC. In the recent quarters, you've seen the slowdown in burgers, but even within burger, you have different growth for different players. So one of the players has done well, the other player has not done well. But what seems to be the clear winner for right now is KFC, followed by burgers and pizzas.
Is looking at investing in the QSR stock. The template 3 years ago was that Indians are going up the value chain. They would be spending more in outside dining experiences, and global brands are something which in a sense are becoming part of their daily ordering habit. That was the whole big picture for QSRs, let's say 3-4 years ago. What to your mind is the picture for investors who want to invest in QSRs stocks now that you got 3-4 options available for next 3 to 5 years?
So Indians are spending more and more on food. There is little doubt about it. If you look at the kind of growth which aggregators have reported, they've seen a massive growth. What that's leading to is really fragmentation of the market. So it's not about the entire growth is really accruing to the QSR space. For QSR right now, the market expectations still seem fairly elevated, close to 15-20% revenue growth, expansion in margins from current levels by at least 300-400 bips. And on top of it, they are getting valuation multiples of anywhere between 75 to 100 times 2 year forward. To us, this really is not a great setup. We believe that the earnings cuts which you've seen in the last 6 months might continue. The last 6 months, you've seen anywhere between 20 to 50% earnings cuts for these companies. And even in this quarter, we've seen anywhere between 10 to 30% cuts in earnings. So on one hand, earnings expectations are being lowered. Forward expectations are still elevated, and valuation multiples to us seem fairly steep. And so there's not a space which we believe is going to make money for the investors in the near term.
All right. Thank you for giving us an overall view on the QSR space and what the outlook is going forward.
If you like this video, then like, share and subscribe to ET Now.